Hello and welcome. In this month's on-demand webinar, OJM Director of Financial Planning, Michael Lewellen, explains how market volatility can threaten your long-term retirement goals and outlines a strategy that can help to hedge this risk. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Thank you for joining us. My name is Michael Lewellen. I'm the Director of Financial Planning at OJM Group. And today we're going to discuss the volatility of the market and how it can be a risk for you in retirement. More specifically, the risk of singlets of returns. But we will also discuss a strategy to hedge against that risk. First, let's look at how long do we need our money to last. As you can see here, the percentage chances if you live to age 65 go up living past 85 to 88 if you're a female, and then obviously 92 if you're both at 65. There's a 25% chance that you're both going to live well into your 90s as well. So depending upon when you retire, and I have some clients that tell me they want to retire as early as 55, they're going to be exposed to the market volatility risk for up to 4 decades. But you can't afford to avoid the market in retirement. Unfortunately, we can't go hide under a rock or put all of our money under our mattresses. We have to be invested in the market and the volatility that comes with it. So you have to be invested throughout retirement. Now let's look at sequence of return risk. This is probably the most infamous decade for all of us, and absolutely in most recent history. Starting in 2000 through 2009, this is known as the lost decade. So you can see starting in 2000, 2001, 2002, we had 3 negative years in the S&P 500 right in a row. Then we had a good run, and then we had 2008, which we all remember, obviously. So this is known as the lost decade. The S&P gave you a little over 1% in that decade. Now, for those of you that were retired, or if we think about if this could happen when you're retired, what are some things that we can be doing? What are some things that we can do to hedge against that? If you were planning to retire in 2008, we talked to a fair amount of people that, well, I was planning on retiring in 2008 or right before 2008, and then 2008 happened. All of those people, they didn't have a hedge against the market, right? So let's take a look at an example for someone, and we will see what it looks like with and without the hedge. So we have a female physician, age 45, with a goal to retire at 65. Now, we're going to look at $2 million in invested assets. And it's important to note that this is a portion of the retirement, not necessarily all of it, but we're just looking at one bucket for this client. We're assuming that she would like to take a net of $100,000 out of this account on an annual basis. So when we say net, that's what she's going to net, not gross. So obviously we're assuming taxes. And in this scenario, we're looking at 33% in taxes. So a gross distribution of $150,000. Now, she feels the stock market gives her the best chance to give her the long-term return that she's going to need. And as we said before, you're going to have to be invested in the market. There is no magic bullet. This presentation isn't going to end with some secret that no one else knows about. It's just looking at things differently. Now, obviously, certain environments, higher interest rates, for example, may allow you to take less risk. Right? You could build a bond portfolio with better interest rates than today, but you still need market return, and ideally in a diversified low-cost portfolio. So we aren't saying that you need to change anything that you're doing. You need to make sure that you have a diversified approach from an asset allocation standpoint, and we believe that you want that to be at the lowest cost as possible. You still, more than likely, most of you listening to this are doing all of those things, so it's not about not doing those things. Well, let's take a look at an example here. In our scenario, we have the $2 million at age 65, and we're taking the withdrawal of $150,000. Now, we spread this out because we wanted to look at a longer time frame. And I wanted to also build in, not just take the lost decade, right? So we start with 1999, where the return of the S&P was almost 21%, and then on the back end, we actually add in 4 positive years. So I don't want to give the impression that we're just cherry picking a bad time frame. We're booking in it with positive returns. But you can see here, quite simply, if you take $150,000 out, starting with the 2 million, all the way down for 15 years, you run out of money. You can see you're actually negative in the 15th year in that scenario. So nothing that we did there. We just took historical rates of returns and used that. Now, if we were able to take out those negative years, right? So what we're saying there in that scenario is every year the S&P has a negative return, the following year we don't take any money out, right? So you can see if we did that, which we would have to do in this scenario 4 times over 15 years, you would have an ending balance of 1.1, almost $1.2 million. That's great. You have more money. It would seem, oh, well, why can't I just use those dollars? It seems like I would have enough money, but as we saw previously, just because of the sequence of returns, you run out of money. Now, the problem in retirement generally is that you can't just not take money. And in this example, 3 years in a row of not taking money, right? That's not a viable option. So we need to be looking at what can we be doing to replace that income, and that's where the hedging would come in. So as a hedge, we want to take a look at using a non-correlated asset, so something that has different exposure. In our example that we're going to look at here in a minute, we're utilizing permanent life insurance, specifically an index universal life insurance policy. Now, the way that this contract works is your performance is still tied to an index, generally the S&P 500, but there's a floor of 0. So that's when we say non-correlated, that's the big part of it. Market goes down 36% like it did in 2008. This bucket of money is being credited 0%. Market goes up, there is a cap on the upside. So think 10% kind of being the most common one. So the market goes up 21% like it did in 1999, you're only going to get 10% in there. So it's smoothing out that sequence of return, right? That's the important thing that we're trying to accomplish there in that scenario. So that's how it's a non-correlated asset. In our example that we're going to be looking at, our female physician is going to take $40,000 and invest it into an index universal life contract for 10 years, so from 45 just for the next 10 years. Now, it's important to note you don't have to use this type of contract. You could use probably the most common, that would be a non-correlated asset, would be whole life insurance. Universal life could also be one that you could look at as well too. Now, in our example that we're going to look at here shortly, the distributions are going to be $100,000. And remember, we were previously looking at, we saw withdrawals of 150. That was the gross that we needed to get to 100. With insurance, inside of a properly structured life insurance contract, distributions can come tax-free. Okay, it's important that it is structured the right way and designed the right way, but you're able to take dollars out on a tax-free basis. So let's take a look at the example. So this is just the insurance that we're looking at here. So this assumes that she funded it the way that we said, that it earned. It's important to look at what we earned. We're assuming that in the positive years, it only earned 6%. And in the negative years, it's credited 0. Okay, so we're not ignoring the negative years there. So we're earning 6%. Obviously, there's years that it would earn higher than that. And in the negative years, we're earning 0. So at age 65, the account value is a little over $900,000. You can see where the negative years follow the S&P. So for 4 years, we're taking out $100,000 to replace the $100,000 we were netting from the taxable account. And you can see in our example, at the end of the 15 years, you have $1 million. Now, this isn't the other $1 million from the taxable account. This would actually be in addition to, and we'll look at both of those on the next page. But you can see what we're doing here, what we're trying to accomplish, obviously. It's a potential source that doesn't parallel completely with the market. You still have some equity exposure in this, which allows you to get better returns, but you've got that downside protection. So let's look at both scenarios really side by side. So on the top there, you can see without the hedge of the life insurance, the taxable account runs out of money in 15 years, so you're in the negative there. With the hedge of life insurance, the value of the taxable account is right at 1.1, almost 1.2 million, but then you also have the cash value of the life insurance, right? So now you've got a total of 2.1, almost 2.2 million dollars. And when you look at the difference there, it's actually 2.3 million dollars. So by taking the steps of hedging against market volatility and the sequence of returns, you've put yourself in a stronger financial situation. I think something that's really important and a takeaway here, this isn't do one or the other. The hedging strategy is something you're going to do in conjunction with what you're currently doing, savings from a retirement standpoint. But as you can see, retirement is going to take a balanced approach. You're going to need to have different tax exposure. We talk a lot about tax diversification. Asset allocation, diversification is really going to be important, having that portfolio with low-cost funds. But we still can't control what the market does. So we still have the risk of market volatility and the sequence of returns depending upon when you retire. So taking the steps to hedge against that is going to put you at a better footing and in a more secure situation in retirement. We can't remove the risk of the market, but we can hedge against it. If you'd be interested in discussing this strategy, please reach out and we can prepare an analysis specifically for you. We look forward to being a resource for you at OJM.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.